Going live. All right, everyone. This is Jasmine with the Note Assistance Program, welcoming you here on a Friday to introduce you to a good friend of mine, Quincy Long. He's the owner of Quest IRA. But before we get started here on this educational event where we're going to be teaching and talking about the benefits of putting notes inside of your health savings account and your self-directed IRA, your educational savings account. So really, Quincy's one of the experts that we lean on here when it comes to finding out the best ways to utilize these tax sheltered accounts. So we're really excited about jumping into that. But before we do, let me just tell you a little bit about the Note Assistance Program for those of you guys who are new to this event. We do this monthly. Occasionally, we will do a few a month. So this month, we are jam-packed. We're going to get at least 3 of these live casts squeezed in, one with Quincy. Then we're also going to have the trading desk at the Note Assistance Program. We're going to have that going. They're going to showcase some assets later this month as well. So just want to take a moment and welcome you to your Note live cast with Quest IRA, brought to you by the Note Assistance Program. If you're looking to reach us, you can reach us here at the number at the bottom of the screen, which is 855-541-NOTE, also known as 6683. So it's 855-541-NOTE. Or you can email us at invest@noteassistanceprogram.com. For those of you who are in Southern California, I'd love to invite you to some of the things we have going on. We have our regularly scheduled Lunch and Learn that's held every Thursday up there in Newport Beach, also known as Costa Mesa. We've got a location there at Crash Labs, and that's 234 East 17th Street. You can also email us for more information on that. That's every Thursday for an hour. We educate you on one slither of note investing, and we really hammer home on that. So a lot of people have found that very helpful with flattening their learning curve and just kind of driving home on certain topics. For example, some days we just spend a whole day going over the mortgage loan sale agreement. So that may be beneficial to you guys if you're in Southern California. As mentioned, our next live cast is going to be with Teresa Jackson. So stay tuned for that. We will send out the dates and times, but we're going to showcase some of the assets that have hit our desk. And some of these things you may be able to implement some of the strategies that Quincy talks about here with some of the notes we have available. So that's it. I'm excited to welcome Quincy back. Now, Quincy just spent a few days with us on the IRA Fund Cruise, the financial, what's it called? Financial Friends Network, right? Right, and so I'm always very excited to be a part of that, and so I just want to take a moment and thank him for inviting me and having me out there as a speaker. We represent him very well for the Note Assistance Program. But Quincy, as you get into telling us a little bit about yourself, please let them know about some of the fun things you have going on in the Texas area, because we do have a lot of callers here from Texas chiming in, so maybe they can attend some of your events as well.
I will do so. It's everything. I should mention that, well, a couple of things. So I want to mention, one is I apologize for the glare on top of my head, but and you got fluorescent lights above you. This is just what happens, guys. I'm sorry about that. Also apologize for my voice. A lot of people came back kind of ill from the cruise. I think they were mainly ill to get back to work. I'm not really sure, but I didn't feel terrific. I don't feel bad, really, but my voice has kind of changed. So I apologize if I have to clear my throat and take a drink of water every once in a while. But should I go ahead with the PowerPoint, Jasmine? Or?
Yeah, please do. Let's get started. I just wanted everyone to know that Quincy is one of our preferred vendors when it comes to self-directed IRAs as well. So if you are in California or Texas or anywhere else, please do check him out. But he's going to tell you a little bit more about this as he gets started. So definitely welcome, Quincy, and thanks for sharing.
All right, great. Let me just share my screen here. Okay, so I just prepared here we go. So I just prepared a little presentation on using self-directed IRAs and other accounts to create, buy, and sell notes. We're not only just going to buy and sell them, we're going to create them. I gave a lot of different case studies about how we do this, or how I've seen people do it, including myself. And I thought it might be fun to share some of those stories. So as Jasmine said, I am H. Quincy Long. I'm president and founder of Quest IRA Inc. And of course, we consider ourselves the premier provider of self-directed IRAs and other accounts in the country. I am an attorney at law licensed in Texas since 1991. That didn't used to sound so long ago, but now all of a sudden it's been quite a few years. Yikes. I'm also a certified IRA services professional, which means I do know a lot about IRAs in general, not just self-direction or real estate. I was for many years a fee attorney for American Title Company, so I have a background in closings in real estate. It gives me a good basis for doing what I do today. I've published all kinds of articles and am co-author and editor of the book Real Estate Investment Using Self-Directed IRAs and Other Plans, along with Dyke Spotiford and George Yider. And I even have an H&R Block franchise in Houston for now. I'm going to sell that here shortly. So that's just a little background on me so you know who's talking to you. Of course, being a lawyer, I have to have my disclaimer now, don't I? So it says that Quest IRA Inc. does not provide tax, legal, or investment advice or endorse any products, services, or investments of any type. And obviously, all we're providing is educational material, and you're always encouraged to consult with your attorneys, accountants, financial advisors before entering into any type of investment. So, how to get that? What's that?
Real quickly, slides are not, so maybe.
They're not moving?
Yeah, so if you click on, let me see.
What slide do you see, Jasmine?
I still see the first one. It just says self-directed.
Well, should I take it off a share? I don't think it's critically necessary to have the slide, but whatever.
Let's just try one more thing. If you just click in the top left-hand corner, I saw something that said start from the beginning. Maybe that'll, you know, make it big and take it from the top. Let's see if that works. Otherwise, you're right.
All right, let's see. Let me go back to the Google. Now I don't see, let me see. Let me see if I can restart it.
Yeah, because I just saw it move, so that might work. If you just go, you know how the top left-hand corner, or it might be right for you, but it says start from the beginning.
Let's see. Now, do you see it moving now?
Yes, indeed.
Okay. Well, we got the little glitch fixed. So, okay. So, I just finished the that slide, so we don't need to see that anymore. Are you seeing the slides changing?
Yep. Now I see what types of plans.
Okay, great. So I always like to mention what types of plans can be self-directed. So that would include, of course, the traditional IRA, the Roth IRA, and that's one we all want, right, Jasmine?
Yes, indeed. Those are some of our favorites. We learned a lot about those on the cruise. Thank you.
Yes, indeed. And the SEP IRA, the Simple IRA, the individual 401k plan, and that includes the Roth 401k component, the health savings account, which I really appreciate, and the Coverdell Education Savings Account. So as we go through all this presentation, just realize that anything I say can be done in any of these 7 different types of accounts. And I just always like to, you know, emphasize that. So are you now seeing the slides change or not, Jasmine? Well, I'm going to assume you are unless you tell me you're not.
Nope, these are good.
Okay, so what can you invest in with your self-directed IRA? Now you got one set up. What can you do? Well, we always like to say that answer that question with the question, what investments are you knowledgeable about? And I think we know the answer to that for the people on this call. But pretty much with very few exceptions, you can buy that with your self-directed IRA. So examples include real estate, including debt-financed real estate. That's an interesting topic, but not one for tonight. Obviously, real estate secured notes, notes secured by anything other than real estate, or even unsecured notes, both of which we'll talk about a little bit today. Options, oil and gas interests, limited liability companies, limited partnerships, private stock, and just a whole lot of other weird stuff that doesn't really apply for what we're talking about tonight. But I only put that up because I want to emphasize how flexible a self-directed IRA or other account really is. All right, so we're going to dig right into it. And Jasmine, stop anytime with questions. Are you seeing the private lending slide now?
Yes, I am, and I will definitely jump in. Just a little reminder to everyone that as he's talking, you can type in questions, and I will bring them up to him to address throughout the program. So thanks again.
All right, so I'm going to start with a simple example of private lending, and this comes from my own portfolio. So basically, I had some small money in little accounts, and I wanted to kind of combine them together so that they could make a loan and just keep on growing, if that makes sense. So I combined my traditional IRA, which was later converted to a Roth, my wife's traditional IRA, which was later converted to a Roth, my mother's traditional IRA, my health savings account, and a friend of mine's simple IRA, all combined together, all 5 accounts combined together to make a $25,000 loan. It was only at 12% interest, so you can see I was being kind of generous. And discount points I charged were 6%. So, and of course I took a first lien position on the real estate. So the story goes that the property was appraised at $45,000 by a professional appraisal, and he was buying it for $35,000. So he's buying it for $10,000 under market, which is pretty good, wouldn't you say? And so then he wanted to borrow $25,000. So if you believe the appraiser, it was a 55% loan to value. I like to stay at 70% or below of the after repaired value. Of course, there's no repairs in this. It's just a piece of dirt. So basically, we made that loan, and he paid on it for about 5.5 years, and we switched it to interest only at 10%. So I'm still making money on that note all these years later. It's been a wonderful deal in this property up in Kingwood. But the point is I wanted to get across here is that you can combine smaller accounts together to do a deal. That might be important to people who are considering investing in the note space. And just an example of a privately done note. Jasmine, do most of the things you do, are they private notes or are they institutional notes?
Most of them are institutional. However, we are bringing a lot of private notes over the next few months, so it'll be a mixed bag overall. But right now, majority of them are institutional. And guys, institutional notes, he's meaning are the ones that I buy. We get from Fannie Mae and from the bigger banks like Chase and then written by those guys versus private ones that are created by a lot of the people we were on the boat with and actually do a lot of this creative financing on their own.
So Jasmine, if somebody wants to turn over a note to the desk, can they turn over a private note or not?
100%. So there are just some parameters that we expect from our vendors who want to sell on our desk. So we do, sort of a suitability and vetting process to make sure that we have some decent, assets on our desk. Obviously, we're not doing all the due diligence for the clients who are buying, but we definitely vet out our sellers to make sure the ones who are creating it are doing it, in a manner that we can definitely foreclose on later. So, with the right paperwork and documentation.
Okay. Well, I just wanted to know. Sorry to interrupt the flow here, but I think it's an important point.
Yeah. No. Great. Thank you. Thank you.
All right. So here's my first attempt at buying an institutional note. So my experience was interesting. So the UPB, the unpaid principal balance, or the unpaid balance anyway, of the note, principal and interest and fees, was around $92,000. Problem was for the people, the property, I purchased the note for $40,000, so that looks pretty good, doesn't it? And the property was not worth 92, it was worth more around 68, and that was if it was fully repaired. But still, I thought, well, $40,000 note purchase, $68,000 secured property, even if I'll never collect the 92, but what the heck, it sounded pretty good to me. So basically, I went to the door, and Jasmine, I don't know if I was supposed to do this or not, maybe you should tell them, but I went and bought the note, walked up to the door, knocked on the door, and sat down with them and said, you know, guys, there's no way you owe too much money. And so the foreclosure is next Tuesday, whatever it was. And, you know, would you like to rent the property back? So I rented it to them for $650 a month, which was under market, frankly. And that was a happy circumstance. I do not recommend doing that, however, because eventually they were lousy with credit before and they were lousy with credit after. Big surprise there, right?
Right, yeah, and actually, great moment for me to bring this up because there's someone actually asking, so how do you handle these situations? And everyone handles these questions different, and just to highlight the question being brought to us by, it looks like Jason Garner out of Alabama. But yeah, so he wants to know, how do we really handle these situations? And everyone's a little different when they handle their workouts. At the Note Assistance Program, we encourage these borrower communications to go through the attorney, unless, you know, special circumstances do arise. But typically we hire a local attorney to handle that, and then through them and our local realtor, we'll have those professionals communicate on our behalf. And more to the point that Chrissy is bringing up, we always want to have a bleeding heart and try to keep the current people in their home, but I have found that to come back and bite me. And
it bit me too, Jasmine. It bit me too.
Yeah, and specifically because you got to keep in mind that these people have already ingrained payment habits, right? So a lot of times you just got to retrain them to make their monthly payments. So that within itself is difficult. And if they find out that they're not evicted and they get to stay still, they almost feel like they've gotten away with a lot, so they're just going to continue with that behavior. Not to mention that they may or may not have the financial means. If they didn't have them, you know, if nothing's changed over the last 3 or 4 years and they haven't paid their mortgage, then it's hard to believe something's changed right now, whether it's their behavior patterns or their financial situation.
So great discussion on this point. I will say that I probably would not handle it the same way today, but I was just like, well, I got the note. They got to know that they got to either get out or sign a lease. So I am an attorney too, so I just kind of went up and handled it. But they paid fairly well. I'm not going to try to, you know, diss them or something. They paid fairly well for about maybe 3 years, and then they quit paying. The guy got older and he had his toe chopped off, and you know, other things happened, and they just quit paying, and eventually I had to evict them. So anyway, no big deal. I evicted them. It's part of owning rental property, right? Everybody knows that. So I evicted them, and then I had a house that, well, frankly, would have been worth maybe $75,000 at this point if I put $20,000 to $25,000 into it. But if you're seeing the numbers here, putting $25,000 into it did not get me $40,000 worth of improvements to the value of the property. In other words, I don't, as a general rule, my personal rule is I don't want to spend $1 unless I can get $2 back. So I put the property up for sale as is, where is, and got plenty of interest. And I negotiated a contract to sell the property that had been mine now for some 4 years at this point, for a net to me of $49,000. Now that doesn't sound like much profit, and it isn't. I probably paid too much for the note, but it was an experience, and I thought, well, come out ahead. I made money while it was being rented. Sure, I've done without a few months of rent while I kicked them out, but I'm just going to take it and run. I don't want to repair the property. And then I come to find out from the title company that the couple had a $200,000 IRS tax lien against them. Well, that's normally not a problem. Let me repeat that. It's normally not a problem for the people to have a federal tax lien against them, because the lawyers normally notify the IRS 25 days before the foreclosure, and therefore wipes out the IRS interest in that house, although they do have a 120-day right of redemption to take the house back if they feel like doing that, though they rarely do. So she said, well, we don't see this affidavit, which is normally attached to the foreclosure sale deed. We don't see this affidavit. And I said, okay, I remember the scenario. because they stopped the foreclosing attorney stopped the foreclosure and said, we got to put it off another month because we need to notify the IRS. So I remembered that conversation. I was like, okay, well, he didn't attach it to the deed. No big deal. It was a big law firm. I'll just, foreclose all over the state of Texas. I'll just go ahead and call the lawyer, and no big deal. So I pulled the file, and I got the phone number, and I called and said, this number is no longer in service. I went, okay, well, all right. So no big deal. I'm a lawyer. I know you have to keep your phone number on file with the State Bar of Texas. So I called the State Bar of Texas, and they said, oh yeah, he's been disbarred. And I'm going like, okay. And he said, and the State Bar took over all of his files, and they were such a jumble. We did what we could, and then we tossed them away. And we're like, oh, this is nice. So now we've got a property with with a $200,000 federal tax lien on it that I can't prove the lawyer gave the notice to the IRS for. And I go like, uh-oh, I'm in trouble, right? Well, fortunately, there is a procedure for removing an IRS tax lien when the IRS was not properly noticed. It took me about 6 months to go through that procedure, but I was successful in removing the lien. And then I sold the property for $55,000 with $10,000 down and a 15-year 8% note, which means I came out way ahead as far as I was concerned. And the people that bought the house did all the repairs and paid me $10,000 down and paid me 8% interest. And it turned a lemon into lemonade, and I've been very happy, and they're very happy. So it worked out well. But what did I learn from this lesson? Due diligence. You got to do the do, as I always put it. You got to do your due diligence. In this case, I had done some due diligence on the property, but not on the lawyer who was doing the deal. And I didn't follow up, even though I knew he had to notify the IRS. I didn't follow up to make sure that he had done so. And had he done so, he would have been, able to help solve the problem. So do your due diligence on the note, do the due diligence on the people selling you the note. And if you're having a professional help you, do the due diligence on the professional as well. That's the lessons I learned from my first experience buying an institutional note.
And that's, if I may jump in, and that's one of the rules of thumb here at the Notice Systems program is vet out your sellers as well. And so that's also one of the reasons that we've created a trade desk. So we only work with people that we have solid relationships for, or I should say with, and for most of the same reasons Quincy brought up. And just on our level, it's also about, little things, are going to go wrong when you're running the business. And so if you find, for example, most recent thing for me, I brought a note and I found out after doing a 32-year title search that there was some litigation surrounding this note. So am I concerned? Not really, because I know this buyer and he's vetted out and he works our trading desk. So it's just a matter of us communicating and finding out, when he's going to buy it back, or if so, or if he's going to get it cleared up. But I'm not worried about finding him again if he disappeared. So always know your sellers. And like Quincy said, do background on everyone involved as much that you can until you get your relationship. And, that's going to take time. None of that can happen overnight. So definitely do your vetting.
Yeah. So, I do want to emphasize there was nothing wrong with the note at all that I purchased, other than I paid too much. There's nothing wrong with it at all. The fault was with the attorney that did the foreclosure, not with the broker who sold the note or anything like that. In fact, he's a well-reputed broker that's still in business today. Anyway, I just thought I'd share that story because it's kind of funny. Now, the next institutional note I bought, I actually did a better job on. The balance of the note was $33,000, and I purchased the note for $19,000. The problem was the note had 0% interest on it. Jasmine, what do you think about that, buying a 0% interest note? Is that a good idea or a bad idea? Or maybe she doesn't want to tell me. Okay.
I'm sorry, I'm always delayed a little bit.
So the $33,000 note had a balance of $33,000. I bought it for $19,000. The fact that the note was a 0% interest note pleased me immensely. Why would you say that? Because my profit is made in the discount on the note. So even though it was a 0% interest note, the yield to me was 13.3% or so. And to me, 13.3% wasn't bad. And that's, by the way, is 13.3% if she pays out for the remaining 110 payments of the note. The likelihood, as you know, is that she'll probably move and sell the house sometime, and I'll get paid the balance, and that will increase my yield a whole bunch. The property, according to Zillow, which we all know is extremely accurate, but it said the property securing the note was worth $127,500. And so, to me,
I have a question.
Yeah.
From Carson, California, and they're curious to know why or what are the benefits of writing a zero interest note. And I'm sure the rest of us would like to know too. Does that have anything to do with how soon they can pay it off? Maybe if it's zero interest, you can do a 10-year.
It's a very good question, Jasmine. See, I knew I put good examples in here. You guys are enjoying this way too much, I think. But I did not write a 0% interest note. This was a privately created note that we purchased the note. This is a brokered note, in other words. Just like some brokers represent institutional notes, there's other brokers that represent privately created notes. Are there reasons to do that? Not very good ones. For example, I don't want to get too deep in the weeds because Walter always accuses me of doing that.
Right.
But, basically, if you write a note for $33,000, for example, then there's a deemed amount that's interest and the deemed amount of principal, and you have to figure that out and report that on your taxes. So it's kind of messy, but people do that for various reasons. One, out of ignorance, and two, they do it because it's simple. In other words, every time she makes a $300 monthly payment, well, the principal balance goes down by $300. There's no reason for me to send any kind of notice to her of her interest payments or anything. So I thought it was a great note. It's very well secured. Even if the property is only worth half what Zillow thinks it's worth, it's still a great secured property. She's paid very faithfully, and I'm making 13.3% in my HSA. It's not a bad deal, Jasmine, don't you think? And by the way, did I answer the question of the people online? If not, type it in again or tell me what I didn't answer.
No, it looks like you did a good job. I did see a follow-up question and just about you, and they're just saying, so on your end, the only thing you were really concerned about is the LTV or the your position and how secure it was, and the neighborhood. Maybe they were just asking what you were concerned about, if not the interest rate.
Well, again, the key point of this slide, besides the fact that I brought a private brokered note, the key point of this slide is the face amount of the interest on the note is completely and totally irrelevant. It's the yield, because you're always buying these notes at a discount. So it's the yield that counts, not the actual face amount of the interest. And yes, I looked up the neighborhood. You can do that through Google, as you know. And I looked up the neighborhood. It's a neighborhood of houses. So it was the collateral was fine. I doubt it's in pristine shape, but frankly, with the kind of values I've got there, I wasn't too worried about that.
Okay.
But the key point again is don't pay any attention to the face amount of the note. Pay attention to the yield after the discount. And another point that the reason I put this up here is because don't make the mistake of counting on an early payoff. So what you do is you buy the note for the yield as if they're going to pay it out the whole entire length of the time. And you hope for an early payout because they sell the house or refinance it. That's just a bonus. But when you're pricing your notes or when you're making a decision, you should make the decision based on the yield as if they paid it out for the whole amount of time. And if you don't know how to calculate the difference between a yield and the face amount of the interest rate, that's a bit of education that you need to acquire, in my opinion. Okay, what do you think, Jasmine?
No, definitely. Maybe we'll try to get a live cast on some education on that. But you definitely have some basic things you're going to want to have, and that would be one of them.
All right, let's move on. I want to give a couple of examples of buying partials. And everybody knows what I mean by that? Probably not. So a partial is, in the other two examples, I bought the entire note. But there's a whole business model out there where you can buy part of the note. When I say part of my note, you can buy a certain number of payments on the note. So if you have a 360-month note, you could sell off the first 15 years or 180 payments, and then you get nothing for the next 15 years, but you get some cash up front, and then you get to pick up the last 15 years of the note. So selling a partial is just selling a series of payments that are upcoming. And so this is what, and it can be a very profitable business, by the way, although there's definitely some learning curve there of how you do that in the documentation. But Jasmine, do you guys deal with partials at all?
Yes, actually, we've just partnered up. Very exciting, and I'm glad you brought this up. It'll be a great place to announce this. We just partnered up with Javelin Management out of Indiana, and I know you're very familiar with Mr. Stropsign.
Yes.
So we just partnered up with him to bring a lot of his what he calls micro notes, and those are pretty much partial, smaller value notes with some great LTVs. And I know you've done some business with him in the past, so have I. So definitely a vetted source, and we're excited to bring him.
Well, there you go. See, this was tailor-made for you, wasn't it, Jasmine? All right. So anyway, here's a couple of examples. This client, and this was in a Roth IRA now. He bought a partial of the note. I don't know how many payments he bought, but he bought it for $10,575. And then the note was paid off a year and a half later, 10/5 of 2006. And the note profit, in other words, he got his $10,575 back, but because they paid the note off early, his dollar profit on that transaction was $11,780.69, which if you do that on an annualized return on investment, cash on cash return, it's 74.27%, which is not bad. So it was a very profitable investment. It was done in a Roth IRA. Sure, it's not a home run, but it's a very solid base hit. And oh, by the way, Jasmine, I always like to make this point, and maybe I shouldn't babble on and make points that are not directly relevant, but the point I'd like to make that I always point out to people, including my staff, is everybody waits for the home run. Oh, I can't spend my money. I'm waiting for the home run to get here. Oh, I know that some people get a home run and I want to be ready. But you know what happens to your money? Nothing. So I always make the point that 4 base hits is still a run in baseball, and it's a run in investing in your self-directed IRA. So I would have no problem doing a small deal like this and making an annualized return of 74%, even though it's not a home run. It's just a base hit.
We find a lot of the same things. Some of the first things we have to do with note investors, depending on where they come from, but that join the note assistance program, is kind of taper them down and bring them to reality as well. A lot of them hear about these fantastic triple-digit returns that people have gotten in the past with notes, and it's a lot to be quick to tell someone, hey, what return are you looking for? I've had this one gentleman say, I'm looking for 38% return on all my deals. Well, we cannot. That's nothing I can promise to deliver to you on a regular basis. You may get something like that every now and then, but like you said, there's nothing wrong with bringing home a respectable double-digit return, 10, heck, even a 9% return. Sometimes if the asset's secure enough, it's in a great location.
Right.
Some base and stop looking for them to a degree.
All right. Well, let's give another example. This is one of my favorite examples because it is a triple-digit return, though the dollars are very small. So same guy actually purchased this in his Roth IRA, 3/10 of 2006 for $13,800. It was a partial. Must have scared the borrower because, sometimes borrowers get nervous when loans change hands. Paid it off 2 months later, 5/4 of 2006, and he made $5,035. Now, I know what some of you think of Quincy, why are you bothering to tell me about a story where 13.8 turned into 18,000? I mean, that's stupid. That's small dollar stuff. But if you do that on an annualized yield, because he made that money only 2 months, that's a 219% annualized yield. Now, true, he's got to find another deal, but I'll take those any day. So that's the world of partials, okay? But let's go on to other parts of the note world. I use this technique, and I've seen investors use this technique, and perhaps it's not a note purchasing thing, so I'll go over it kind of quickly, but instead of making just a straight loan, I have made loans which were shared appreciation equity loans. So this one example, again, this is my own portfolio, so I'm using myself as a guinea pig here. And I paid $35,000 for a note that was for the purchase and rehab of a mobile home. Now, don't laugh at me because they're very nice, 1,800 square foot mobile home. It's a beautiful piece of property, southwest of Fort Worth. And I think the same tenant's been in it now for 8 or 9 years because they agree it's a beautiful place. But anyway, so $35,000 was enough to buy and purchase it. I only charged my partner 10% interest, so you can see I was being kind of generous. But I limited the loan term to 5 years, but then basically I said, well, give me my money back and half of the appreciation of the property. Because I was betting, this was back in 2009, 2010, must have been 2010, based on the expiration date of the note. I was betting that real estate was pretty well on sale, and the property rents between $850 and $900 a month. So I would say that was a pretty good cash-on-cash return. And so in the meantime, I got 10% interest, which was basically about half the net profit of the property. And I got an appreciation, any appreciation of the property when he sold it. Or if he didn't sell it at the end of 5 years, we had the property appraised and he paid me the difference.
Now we go back into your tax shelter account, correct?
That's right. So this is all in, I don't remember. I think this is in, this may also be in my HSA. I like notes in my HSA because they're simple. Okay.
Well, that's to a question. We've got actually two questions here,
okay,
and one you. So one of the gentlemen would like to know, and this guy is out of High Point, North Carolina. He wants to know, how do we invest if we have $1,000 or less in our account? And so it sounds like,
well, that's coming up.
Okay, great.
Not there yet. What else?
And the other question was, someone had questions about the health savings accounts. I know you're getting to that. I can wait, but they wanted to know, how that is a supplement to, and I'm quoting here, the Obamacare stuff. How can we take care of our families, and that, how can that help us?
Of course, that's a whole nother webinar, and I do have other webinars that are pre-recorded on both Coverdell Education savings accounts and health savings accounts. So basically, the short answer is that basically, if you qualify for the health savings account, you get to both deduct the money that you put in there off of your tax return, and then you get to pull it out tax-free. So it's the only account that you get to do both, put it in tax-free and take it out tax-free. Every other account, you either put it in before tax and take it out taxable.
Wow.
And after tax and take it out, tax-free later. So it's a wonderful, really wonderful vehicle if you qualify for it. And just have the caller, just call our office if you want to ask questions about HSAs and whether you qualify. That's the best thing to do for that.
All right, and I'd love to get to some of your pre-recorded, if I can, maybe I find them on YouTube, but I'd love to disseminate that to our database as well.
All right, well, we can talk about that over email, all right? But you can find all this stuff on questira.com, of course.
There you go.
But let me move on, okay? Oh, this was a crazy one. Okay, I probably shouldn't even have this in here, but I left it in here. What the heck? So I've been very blessed in my life, Jasmine. I like to pay it forward, if you know what I mean. I'm sure you've heard that phrase. So I decided I was going to encourage a young person to help them get started in business. And so I did a convertible note. And the deal was I loaned them the $6,000 for startup money, and I charged them only 6% interest. So you now think I'm insane, I'm sure. But basically it was 6% interest, or the higher of 6% interest, or half the profit from the inventory that they bought on that with that $6,000. So, and then I had a conversion option, and this was the really fun part. I had an option to convert that $6,000 note and exchange it for equity in the entity that they were going to set up should their business succeed. And they formed a business. I was going to be a partial owner or I had the option to be a partial owner in the business. So the concept of a convertible note, a note, in other words, a debt convertible to equity in the project, is not a new or invented thing by me, but it was kind of a fun deal. Now, what happened is the young man that I sponsored to do this was very successful very quickly and wanted me the heck out of the deal, or wanted my HSA out of the deal, in fact. So we negotiated back and forth, and he paid me 25% return, or $1,500 on my $6,000, paid it in about 10.5 months. So I figured, well, I got him started in business. I made 25% return in less than a year, and I feel good about that. But this may be a little advanced, but I thought it was just a fun story of thinking differently about notes, and not just, oh, I loan you money and you can pay me back with interest and payments. You can actually get quite creative, and we're going to continue down the creative path now. Did you have any questions on that one? But if you do, just let me know. I'm going to move on then.
Okay, yeah, definitely.
Okay, well, now this is a story of a wrap note that I actually did. Let me see. I thought I deleted this thing. Well, I tried to delete it. Well, let me just say what a wrap note is, because the next example is a wrap. I didn't want to drag on too long on your cast, so I deleted this. But basically, in 2002, I took over a property subject to the existing mortgage. So if you hear the term subject to, that's what that means. You're taking the property, you're not assuming the debt, but you're taking the property subject to an existing mortgage. At the time I took over the property, it was the balance on the mortgage after catching up for the pre-foreclosure was $53,958.83, and it was a 180-month loan with 142 months remaining. In other words, they paid a little over 3 years on the note, which meant that the note was amortizing quite quickly. And the interest rate on the note was 6%, and the monthly payment was $531.63, excuse me. So what happened is, and I don't have the slides because I thought I deleted the whole example, but what happened is I turned around and I sold that property to a couple of ladies that bought it, and I sold it to them for, let me get this straight in my head, I sold it to them for $80,000, I apologize, for $80,000 with $9,000 down and a $71,000 note that was 20 years. Now remember, I had 142 months remaining on the note that I took over, and then I gave it to them for 20 years at 10% interest, and I was paying 6%. So if you think about it, I was making 4% on the bank's money because I was charging them 10 and paying 6. But a lot of my cash flow was eaten up because I was letting them pay it over 20 years, and I was paying my balance in 142 months. But it was okay because it did cash flow $120 or so a month, and a year and a half later they cashed me out and refinanced my wrap note. I paid off the underlying note, and I had made basically between the difference in principal that they owed me and the principal that I had owed the underlying lender and the cash flow from the monthly payments, I made about $20,000 on that deal, mostly using other people's money. So that's kind of the base concept of a wrap note, is taking it over subject to and then wrapping that note with a note that kind of the payments on the wraparound note includes the underlying note. And I'm going to give a much clearer example. It would have been clearer if I had left those slides in there. But let me move on to the other one, and maybe this will be a little clearer concept.
Okay.
This, if you got any questions, interject them, but this will clear it up a little bit here, I hope. So this is our friend Walter Wofford in Jackson, Mississippi, Jasmine. And basically he could acquire this note for acquire this property for $27,000. Now Walter's what he calls himself is an accidental do-gooder. So what he'd likes to do is provide seller financing to affordable houses in Jackson, Mississippi. So he's able to pick this up for cash for $27,000. And basically he was able to sell it immediately to a homeowner for $48,000 with $4,000 down and a $44,000 balance on the note. What's the problem with the scenario? Well, if you're going to spend your cash and take seller financing, there's little difficulty with that, isn't there? Because then you run out of cash pretty quick. So Walter doesn't like to put his own money into any kind of deal. So basically, he created a first lien note of $31,000 at 7.75%, 103 payments of $414.16 each. So that's the note that was created. Then he sold that note at par, which means he sold it for the full $31,000 to a non-related party who was satisfied with 7.75%. That's only like an 8.5-year note, so it amortized very quickly, and more importantly, he created a wraparound note of $44,000, again 7.75% interest, but in this case it's 180 payments of $414.16 each. Now Jasmine, what that meant was that since the wraparound note includes in the payments of the wraparound note the payments for the underlying note, you can see that there was zero difference in this case. In other words, the wraparound lender was going to get nothing for 8.5 years or 103 payments. But then what do they get? Well, they get the remaining 77 payments at the end of the note. But think about what Walter did in that case. He's the real estate investor in this. He got $31,000 to buy and stick $4,000 in his pocket, right, for the purchase. And then he also got the $4,000 down payment. And so basically he stuck nearly $8,000 in his pocket for EAT money. And then he also had something left over, which was 77 payments in the future, starting 8.5 years out, of $414.16. Well, Walter basically called on me and said, do you know anybody interested in the note, the 103 payment note? And I said, yeah, I think I can find somebody. It took me about 10 minutes. So Walter used his network, i.e. me, and I used my network to find somebody to get him the money he needed to buy and stick some money in his pocket and then sell the property. And so I said, well, Walter, what's in it for me? He says, I'll sell you or your daughter's Roth IRA 1/2 of the wrap note for $500. So basically my daughter bought for $500 a wraparound note with initial equity of $13,000 if they paid it all off. But if they didn't pay it off, she bought 177 payments starting 8.5 years from now of $207.08 a month for $500. And why is that significant? Well, I only say it's significant because basically the first lien wrap lender knew that my daughter was lurking behind him on a wraparound note and deed of trust, right? And that she wasn't about to lose her $500 or her 77 payments of $207.08 a month. So basically that gave nice and warm fuzzy feeling that the greed factor was going to be there, and the second lien holder was not going to, the wrap lien holder was not going to let it go to foreclosure. So that was kind of an interesting deal that we
That's a great example. I gotta thank you for sharing that. Guys, I don't know if you may need to go and rewind this. This will be archived for viewing pleasure, but go back and listen to what just happened. He demonstrated quite a few things, and specifically to answer the gentleman's question in Carson, he demonstrated how he took $500, less than $1,000, and muscled his way into a deal, and all that money,
right,
one way or the other, back into the account.
You're kind of fading in and out, but I think I got the concept. This was one situation where a very little amount of money bought a wrap note with $13,000 equity. Well, how could it do that? It could only do that because it utilized okay, my daughter utilized my network, but whatever. She utilized her network to find the money, and therefore she was able to buy an asset for a really cheap price, though it's not an immediately paying asset. Now, some of you also may wonder, why in the heck would I do this in an 18-year-old's, now 19-year-old's Roth IRA? I mean, really? You know, by the time she uses that, I'll be dead. Well, I think that's pretty good parenting, isn't it? To teach them that at 18 or 19 that they need to start thinking about when they retire, and that payments 8.5 years from now are just as good to her because she doesn't need the money in the meantime. So anyway, that's what I did, and it was a good story, but the story involves wraparound notes and deed of trust. It involves buying real estate without any of your own money. It involves using your network and other people's networks, and it involves taking a small amount of money and creatively turning it into a nice profit down the road. So it's a pretty good story. So you can ask the questions again. You'll be able to contact me by email, and I'm sure Jasmine would handle any questions.
If you can give them your contact information, we'll do it one more time because again we'll be wrapping this up here in a good 10 minutes. But give them some information because I got to tell you guys, I'm having a changing of the guards here at the Note Assistance Program. We actually are letting go of our sales assistant, and she's being replaced with another person. And what we did for her on the way out is we opened up 2 educational savings accounts for her daughters before she left here. And so part of the reason I'm telling you that is, you know, we want people to leave here in a better position than when they met us. So even a lot of the deals that Walter and Quincy are talking about, they're leaving meat on the bone for the other people. So I'm also using it as a plug to say Quincy. Now that we've got my son's IRA and my assistant's, please call us with your next $500 deal.
Sure. Okay, I just wanted to point out also that there are other ways to do the same deal, just different structures. Instead of doing a wrap note, you could have had a single $44,000, 77.75%, 180-month note, and instead you could have sold the first 103 payments to raise the same dollar amount. It's just a different structure than the wraparound note with 103 payments wrapped around by a 180 payment note. Just a different structure. Another way that you can do it is instead of having one note and then a wraparound note, you could have a first lien note of $31,000, which you did in this case. But the second lien note could be a wrap, but it doesn't need to be a wrap. It could be a second lien note that has only payments starting on the 104th month. That's what Walter and I call the two-noter model. And, you know, it's the same difference. These are 4 different ways you can do the same deal. And so, again, a first and a second note is another choice. But somebody pointed out to me as I was riding on the plane, you could mess with this any way you want. If you had the same $414.16, you could slice and dice it any way you want. So you could have a first lien note of $31,000 at 6% with 180 payments. If you could get somebody to buy that, then you could jack up the price of the second lien note for 180 payments at 11.584%, and you'd still come up for the homeowner with the same $414.16 a month. And so that would mean that if you did that, you would have a second lien note with a cost to your Roth IRA of 0. 0 is a pretty good number. So I know that was awful quick, but I just gave you 4 different scenarios of how you could do the same deal and make the same deal to the homeowner who is now able to own a house for much less, couple of $100 less than they could rent that same house for. And that is the actual house, by the way.
Now, that's a wonderful example. I did get a question that's taking us back just a second, so if you don't mind answering, I think it would be awesome. So I have a young lady out of San Diego who says that you have to have a high deductible health insurance plan in order to open up an HSA.
Yes, you do.
And explain a little bit about why someone would not be able to, or what the purpose of that is, please?
Well, again, that's better suited for the HSA class because we are kind of limited on time.
Okay.
Basically, it's a specifically designed type of health insurance plan, which, as you know, as the title indicates, it's a higher deductible, and you get basically no reimbursement until you reach the deductible, and then the insurance company has to start paying, and there's a maximum out of pocket to your family that they also reach, after which they have to pay 100%. But go ahead and call the office for questions like that, and we'll be happy to answer them.
Gotcha. Okay. We'll save that for another call, and we'll send our resources. Thank you.
All right. So how should you hold title to discounted notes in your IRA? Well, you can hold them directly in your IRA. You can hold them through a trust or an LLC. Basically, we don't care. However you want to do it. There's some advantages to each. Direct ownership by the IRA is simple, but ownership through a trust or an LLC may be appropriate where you need to work the account or something. We don't care. However you want to do it is fine. Let me see. I think I'm going to kind of skip over this. Well, let me go ahead and do it. I'll skip over the other example. This is an example, an actual purchase of okay, I remember what it is. I'm sorry. Got to remember the example. I actually did this deal. So the investor, which was not me, bought a house for $14,000 and sold it to a new buyer for $23,000 with $1,500 down and a $21,500 note with 7.75% interest, 72 months, 6 years, in other words, of $374.75. Now, if you just stop right there, you can see that you might wonder why this deal would even be done in the first place. Well, what happened is the house was worth nearly $90,000 and had a fire. And the person that was buying it was the contractor that was going to fix it up and move into it with his family. So it's a pretty secure deal. So again, the investor doesn't want to use his own money, so he needs $14,000 plus his profit out of the deal. So he calls me up and says, Quincy, you want to buy this note for $19,000? And I did a little quick calculation. I said, 12.2925%, not bad, I'll take it. So I bought the note at $19,000, so I got a discount of $2,500 on the note, and things were rocking along, and I decided, what if I wanted to sell that note? And the lender was a trust, actually. That's why the sale and trust thing is up there. So I thought, well, there's 3 ways at least to sell a note. You could sell the entire note, of course. And if I sold the entire note at a lower yield, so this is a difference in the yield, right? I bought it at a 12.3% rough yield. And I said, well, that's such a secure note that I bet somebody would buy the note at a 9% yield. And it turns out that a 9% yielding note would sell for $20,767.76 as opposed to the $19,000 that I paid. So I could sell that difference in yield for $1,767.76 instant profit. Now, if I only had $100 into the deal because I had an option on it, or I brought in a co-investor to bring in the rest of the money, that would be a pretty good way to stick some money in your account really quickly, right? So that was one way to do it. Another model that I came up with is instead of selling the entire note, I could sell 91.39% of the note, and that would mean that my Roth IRA in that case would keep $32.26 a month, because obviously a note yielding 9% takes less money to amortize than a note yielding 12.2925%. So the difference of $32.26 I could keep in my Roth IRA, and then if he pays it out over the 72 months, I make $2,322.72. Now, if I only had $100 in the deal, and every 3 months I get $100 back, for 72 months I can do this rinse and repeat, do it over and over and over again. But there's a third model. What if instead of, and that's selling a partial, what if I still need $19,000, if I want to give them a yield of 9%, I could sell the first 64 payments of the 72 payment note and retain the last 8 payments, giving me a profit of $2,998 that's completely tax-free. And again, if you had little or nothing into the note deal, that would be a pretty nice profit, although you'd have to wait in that case for a period of time to achieve your profit. So those are just 3 different models that I created for selling the note. And the reason I did this all in trust, because then I can switch the beneficial interest of the trust around any way I want to slice or dice it, and just the trust is undisturbed as the owner of the note. So sometimes when you're playing around with partials and stuff like that, it's more fun to do it in a trust. Anyway, that's my story, and I'm sticking to it. So,
Great advice.
can you be your own trustee or manager for an IRA-owned trust or LLC? Let me just say no, and the reasons are very complex, but let me just say no. You don't want to be your own trustee or manager for your IRA-owned LLC. That's just not going to work, and I don't have time to go into that. But same thing on the, can you purchase an option or a right of first refusal on the note? Well, yes. I mean, again, we don't have time to go through a whole course on options or rights of first refusal, but you can use those techniques to get a right of first refusal or option on a note. Then you can sell that option or right of first refusal for a profit, just like you can sell the note for a profit. Now, you don't want to flip notes in your IRA, but in this case, buying an option on one can be a very powerful thing. Let me just give you one quick example, because I know we're going to run out of time. Let me give you one quick example. I'm sorry?
Yes, here another example. We'll watch that time, but it'll be okay.
Okay. So Walter Wofford, again, our friend in Jackson, Mississippi, what he does is he creates the first lien note that he needs to buy the property and whatnot, and he's going to use it as he's going to be a landlord on it. Basically, he's keeping the property in this case, and he sells an option for $5,000 on the property, subject to the existing lien. They can acquire half the balance, half of the property for a total sum of the $5,000 they paid plus half the balance of the note. Well, his thought is, as the balance of the note goes down, that $5,000 looks like a better and better deal, and at some point the note disappears, and you can just exercise your option to buy the property, buy half the property for essentially zero cost at that point, or at any point during the term of the note. As the balance goes down and the value goes up, at some point it's going to cross the value with the debt, and you may want to go ahead and exercise your option. So that's just a real super quick example of how to use an option in connection with a note to get a real estate deal done. See, we could go for hours on this kind of stuff, but I guess we won't. Can you do a big question? And I think this is one that Jasmine is my favorite slide for Jasmine, right?
Yes, indeed.
Can you do collection and servicing your note? Generally, this is not a good idea. One, because one of the prohibited transactions in a self-directed IRA or other account is providing services directly or indirectly to your IRA. And, you know, you can make good investment decisions. That's not what I'm talking about. When you're actually servicing a note, I've heard people say, oh, I got this great shock and awe, and I negotiate with the buyers and all that kind of, the borrowers and all that. You know, if you're doing that, you're providing a service for which you're normally paid, and you're just donating your services to the IRA. The IRS does not like that concept, and though probably nobody would say anything about it, if you're following the rules very strictly, it's better to have a third party do any kind of servicing on the note, and certainly any kind of workout on the note, because this is going to get people in trouble if they do that excessively. Any comments, Jasmine?
No, I'm actually, as you know, glad that you touched base on that, and that leads us into wrapping the call up and just telling you briefly about our reinsurance program. And we created that specifically at the Note Assistance Program to help people stay out of that gray area. So we've got documents in line with companies like Quest and some of the other people we work with that allow us to do most of the communications, and then even finding the services that you need to be provided and things of that nature. So this keeps your hands off of the fingerprints off of the account and avoids a lot of those gray areas when you're talking about auditing. But no, thank you, because that's one of the things that, some people they like living a little until it hits the fan, right?
Right. Well, just another quick note, and then I'll wrap my part up. People ask me all the time, do they need to worry when they're creating a note about Dodd-Frank, or I call it Dodd-Frankenstein? And the answer to me is yes, you do need to do it. One, it's just the way the society has changed, and you got to live with it. And the cost is ultimately paid by the homeowner anyway. And most importantly, for the listeners that you have that are creating notes out there, the point is that the value of a note will be much greater as the years roll on if you got Dodd-Frank compliance paperwork with it. So it does create value. I won't go into
that's just one of the things when we vet out our sellers, so that when you're buying notes, we try our best to make sure that if it's not coming from the buyer, that the person creating it is following Dodd-Frank to the best of their ability, so that you buy a note that's going to cause you less trouble in the long run. It's a great point, principles.
All right, and you do have to value your assets every year. Presumed value of a note is the amount owed, so you may want to change that, especially if you're buying defaulted notes. You may have to have a note valuation. We kind of already talked about the 3 models for buying a note, and again we talked about the fact that in the model where you only have $100, or one of your listeners said $1,000, if you could buy part of a note and then say bring on a co-investor for the balance of the money you need. In this case, if you had $13,000, you could buy the note and sell it for $16,000. That would be great. But if you don't have the money and you have only $100 and you put down an option on the note for $100 and you bring on a co-investor, that's what CI is on the screen for, a co-investor for $12,900, they can get the next 43 payments on the note for a 16% yield, or you could sell them 75% of the note. Again, these are the same models that I discussed earlier, but the point is, if you have very little invested in it, rather than flipping the note, you stay in the deal with your $100 and you get your $100 back very quickly, and rinse and repeat. So it's just another set of examples of the $100 note, or the $100 models that I discussed earlier.
Right, and that's one of my favorite things to hear you talk about. Quincy, do us a favor and share with them the best way to communicate with your firm. I know I work with a wonderful lady named Crystal. I don't know if you want to give us her information, but how could they contact you to find out more about? We're getting a lot of questions on the health savings account, so we may have to have you back on that. But how could they communicate with you?
Yes, well, as you see, hopefully on the final screen here, our contact information. Again, we are questira.com. That's QUEST IRA.com. My email is Quincy or Quincy.long, either way, at questira.com. I also have a blog, by the way, at www.askquincy.com, or IRA Web Advisor is another point to the same blog. And so you can actually type in questions and they'll come through that website to me and my assistant, and we'll answer those questions. And if we find it to be interesting enough, we'll sanitize it and then put it up on the website. Also, we also have a toll-free number, just like you do, Jasmine. It's 855-FUN-IRAs. That was my invention, 855-FUN-IRAs, or 855-386-4727. Look forward to hearing from you. Look forward to working with you and your people on these notes as they purchase them in their IRA. Thank you very much.
My pleasure, and thank you for the guys. I just want to let you know that he does have another Financial Friends Network cruise coming up in January. Is that correct?
That's right. We can't stand to wait too long to do another one. So the last one just finished last week, and we're off again January 22nd to the 29th out of Galveston, Texas. Nice cruise, and then we're off in September of 2017, not 2016. To Alaska out of Seattle, Washington. So you can get those information on all the trips that we take. There's more than just those on www.financialfriendsnetwork.com. That's www.financialfriendsnetwork.com.
Wonderful, wonderful. Well, Quincy, thank you for taking time out. I know you are swamped like the rest of us, just getting back from the cruise, so it means a lot that you would take a moment to inform us on the things you know so much about. Again, guys, I highly encourage you working with Quest. And if you have any questions or you need any documents, we also have them here for the program. I'll be happy to connect you. And that's it. Take care. Happy Friday, guys.
Thank you.
A pleasure. Don't say goodbye to anybody.